This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our previous session together, when looking at takeovers, we learnt that where a share-for-share transfer takes place to enable that particular takeover, because you are swapping one bit of paper, one type of share, for another bit of paper, another type of share, that paper-for-paper transaction does not crystallise again. What automatically happens is that something called share-for-share relief applies. And what does that mean? It means that there will be no immediate gain crystallising. The value at that point in time of the shares doesn't matter, because what does matter is on a share-for-share deal, share-for-share relief means that the new shares take on the cost of the old shares. So, for example, as we discussed last time, we might see a situation whereby a taxpayer owned 10,000 shares in A Limited that cost £100,000. 10,000 shares, A Limited, an unquoted trading company. And those shares had cost £100,000. But now A Limited is taken over by VPLC. You'll notice I've introduced here, we're going from an unquoted company, A Limited, to let's assume that the VPLC is indeed a quoted company. And A Limited is taken over by VPLC, the deal being whereby VPLC issues 4 shares in VPLC for each A Limited share held. At that point in time, VPLC shares were valued at £5 per share. Now this is a single simple deal. There are shares held in A Limited by the taxpayer, and they are to be exchanged for shares in VPLC. So what happens? The new shares step into the shoes of the old shares. At the moment, the taxpayer has a share pool in the name of A Limited, and that contains number of shares, 10,000, cost of shares, £100,000. All that is now going to change is that the name of the share pool will change from A Limited to VPLC, and the number of shares will change from 10,000 to, well, how many? VPLC issues 4 shares for each A Limited share held. So 10,000 shares in A Limited times 4 shares. Each A Limited share gets 4 shares in V. 10,000 times 4 is 40,000. So you now have a share pool containing 40,000 shares. This is in the name of VPLC, but those 40,000 shares are still deemed to have cost the same as the A Limited shares. The new shares stepped into the shoes of the old shares. They acquire that cost. So at that point in time, no gain crystallises, share-for-share relief applies. Now the VPLC shares, of course, were valued at £5 per share. Now if a month, 6 months later, they were sold at £5 per share, you'd have 40,000 shares being sold at £5 per share. Well, that, if my mental arithmetic is correct, is £200,000. That's your sales proceeds. The cost, that's what you inherited from the A Limited shares, 100,000. So at that future point of sale, sales proceeds 200,000, cost, that was the cost of the original A Limited shares, 100,000, gain £100,000. And then the question arises, as it always does, that having computed a chargeable gain, what Cgt rate will be applicable to that? And what do we know about Cgt rates that may be applicable here? Clearly, shares, be it in A Limited or in VPLC, is not residential property. So the 18% and the 28% rates clearly do not apply. So that leaves us where we said other assets would have a 10% or 20% rate, depending on whether from our income tax computation we had any remaining basic rate band available. If we did, then any such remaining basic rate band available, that would be taxed in terms of taxable gains at 10%, And as soon as you move into higher rate, you go to 20%. But there was a third category in terms of tax rates. It was a similar number, it was 10%, but with no upper limit other than an annual lifetime limit of £10 million. Not a figure as yet you know. What that was to deal with was entrepreneurs' relief. If you were disposing of a business, whether that's the assets and trade of an unincorporated business or shares now in a trading company, then entrepreneurs' relief, if you satisfy its conditions, and in the next chapter, in the next lecture, the first of the reliefs that we deal with in chapter 14 is indeed entrepreneurs' relief, so we'll see it there. Then, if the particular disposal qualifies for entrepreneurs' relief, then up to, it does have this lifetime limit of £10 million, then you get a 10% rate. Now, the issue here, let me take you back to the notes that we have. We come as far as note C, but here in note D, we are reminded that this treatment is automatic, this share-for-share relief. If you comply with its conditions, that will be the case in any exam question you do. It's automatic. The share-for-share relief automatically applies. However, the shareholders can elect for the event to be treated as a disposal for CGT purposes and for the gain to be immediately chargeable. Where would that happen? Where would this be an advisable course of action to recommend to your taxpayer? It would usually happen where the original shareholding now being sold is eligible for entrepreneurs' relief, as we've just discussed, and no, a tax rate of 10%. And that, as I say, you'll see the detail of in chapter 14 in our next lecture together. But the new shares that you acquire would not be eligible for entrepreneurs' relief, easy for me to say, on their future disposal, and would therefore probably face a tax rate of 20% instead of 10%. Why 20%? Because this taxpayer will be a higher rate taxpayer. From the income tax computation, you're a higher rate taxpayer, and therefore the gains would be taxed at 20%. Therefore, what we are suggesting is we disapply the share-for-share relief. We elect to say, no, don't want share-for-share relief. I do not want that gain to be deferred, because if I do that, in the future when the gain crystallises, it's going to be taxed at 20%. If I choose to tax it now, which I'd rather not, of course, if the relief allowed me to avoid being taxed at 10% now to be taxed at 10% later, I'm very happy with that. But if it means that probably a relatively short delay between being taxed now and taxed later, I'd be taxed now at 10%, but taxed later at 20%. I don't want to double my tax charge, and therefore I would make this election, or you would recommend to your client that this election is made in order to, though you pay tax sooner, you're paying at 10% rather than 20%. Now, you don't yet know the details of entrepreneurs' relief and the qualifying shares. You'll know that in our next session together when we deal with Chapter 14 reliefs, the first of which, as I said a moment ago, is indeed entrepreneurs' relief. And what you'll discover is, when we talk about shares in trading companies, there's a minimum level of shareholding that needs to be held for entrepreneurs' relief to then be available. And that minimum shareholding is 5%. And the situation that you usually get this in is this one. You have a shareholder in this example who owns shares in an unquoted trading company. And that 10,000 shares, let's just get rid of some of this circling here, that 10,000 shares was probably significantly greater than a 5% interest. But if it is a 5% interest, and if the individual is an employee, that's another condition that needs to be complied with. Then under those circumstances, entrepreneurs' relief would be available at any future point of disposal. A few other ownership period rules that apply. but that's for next session. So the shares in A Limited qualify for ER, but you get taken over by VPLC. That's going to be a much, much bigger company. And what will happen is your percentage shareholding will be hugely diluted. You might go from a 25% shareholding in A Limited, the unquoted trading company, to a 0.1% shareholding in VPLC. Clearly, anything that is below 5%, the minimum required for entrepreneurs relief to be available, you lose out on entrepreneurs relief. It means, therefore, that you now have that choice. If you do nothing and therefore share for share relief automatically applies, there's no gain taxable as we've seen at the point of takeover. But on the future disposal of your new VPLC shares, any such gain then, because you're a higher rate taxpayer, is going to be taxed at 20%. Therefore, if you'd be taxed now on your A Limited shares at 10%, then that is a good idea. So what do? We elect to disapply the share for share relief. We've got tax now at 10% instead of tax later, probably not much later, at 20%. We've halved what would otherwise have been the tax liability. That has to be a good idea. And this is the situation where you see it in. Usually where you go from a 5% plus interest in a company that is now being taken over, a company in which, as I said, for one of the other conditions, you are an employee, to a bigger company where, again, you may very well be an employee, so you satisfy that condition, but you don't own 5%. And that, therefore, means you would lose the availability of entrepreneurs relief. Best idea, therefore, elect to disapply that relief. Going back to the notes, therefore, hopefully now we understand note D. What we also saw last time, which made the calculations more interesting, shall we say, just a little bit more demanding, was that usually in exam questions, when a takeover takes place, other than testing the issue that I've just gone through with you there, you get not just a single shareholding in the takeover company, ordinary shares, you get a mixed consideration. And the usual mixed consideration for us with our syllabus that is tested on you now at Tax UK, as compared to your advanced taxation syllabus, it's likely to be a mix of ordinary shares and preference shares. So what do? If again it was share for shares, ordinaries and prefs, it's share for share relief. But this time, instead of all of the cost belonging to all of the one type of share that you acquired in the takeover company, your original cost of your original shareholding, instead of all being attributed to one new shareholding, has to be divided between two new shareholdings, ordinary shares and preference shares. And how do we do that? What basis at the point of takeover do we use to split your original share cost? Like in this example, the £100,000, what do you use, therefore, to split that out? You use the market values of the consideration received. What is the market value of the ordinary shares? What is the market value of the preference shares? And you use those market values. Remember the working that we did, list out the open market values. You use those market values as a basis for dividing out here what would be the original cost of £100,000. That's what we do. Should then any of those shares be sold in the future, any exam question would take you past just the point of takeover to a future disposal of either the ordinary or the preference shares. You know then how much you sell those shares for. You look back to your working to establish how much cost is to be attributed to each of the ordinary share and the preference shareholdings. As soon as you've sorted out your allowable cost, put it against the then proceeds of the ordinaries, of the prefs, whatever it might be, and you can compute then your chargeable gain. So again, in that situation, where the mixed consideration was just different types of shares, it was still share for shares, and therefore share for share relief applied. So there was no gain that immediately crystallised at the point of takeover. What we're now going to see in this last little section is something might change at the point of takeover, such that you do crystallise an immediate gain. Now, what's going to happen? What is going to happen is, again, it's mixed consideration, where no doubt the majority of that consideration is going to still be in the form of shares of one description or another, but also this time some cash would be received. And that, in all honesty, is a more typical situation in real life. If your company is being taken over, you are unlikely to just want to accept shares in the new company. Wherever you take shares, there is a high degree of risk. Those share values could go up, but equally they could go down. They could go down a very long way. Therefore, when your company is being taken over, you would probably want to receive at least something in the form of cash. That money in your pocket, you could take that now. You're not going to lose that in terms of any fluctuations in value of the new company in which you have now become a shareholder. So what we find is that there's some cash consideration. So here in note E, if at takeover some cash is also received, then a capital gain needs to be calculated at this point of takeover. We must calculate the gain at the point of takeover for the amount of cash received, for the cash element received. Now, there's an example 5 that you'll be able to have a go at separately in a moment. But what we will do is just go back to an example that we were using back in our previous longer session that dealt with, amongst other things, takeovers. And if you go back and look at the information in that particular question, all I'm doing here is just change one thing, and that is the terms of the takeover. In the example that I gave you, the taxpayer, I think by name Aston here, for each share held by Aston in Villa Limited, for each share held, Aston received, now as before, 3 ordinary shares in, I think it was FC Limited or FC PLC, whatever it was there, but in that takeover company, that were valued at £4 per share. The other part of the consideration was preference shares. And again, you were told for each share held in Villa Limited, how many preference shares you received and what was their then market value. What we've got though now is for each Villa Limited share held, you had £3 of cash in addition to the ordinary shares that you acquire in FC Limited. FC Limited also gives you £3 in cash. Now, if you look back to that example, as I've said, you discovered that our taxpayer Aston owned some 10,000 shares in Villa Limited. So what do we do? It is exactly the same working when dealing with mixed consideration that you used when looking at a mixed consideration that was ordinary shares, preference shares. Now what we've got is one form of shares. It happens here to be the ordinaries, but instead of other shareholdings, we've got cash. So what do? We list out the market values of what you have received. It's always our first working exercise. So what do we get in the way of ordinary shares? We had owned 10,000 shares in Villa Limited. We are now issued with 3 shares in FC for each Villa Limited share held, and each of those shares are worth £4 per share. So we got 30,000 shares at £4, which equals the same as it was in the previous session, of course, £120,000. For each of our Villa Limited shares, the taxpayer Aston also gets £3 in cash for each of those 10,000 shares held. So instead of what was then preference shares worth £30,000, we receive cash of £30,000. And if you receive cash, then you have crystallised a gain. There is an immediate gain. If you've got cash, immediate gain crystallised, that's going to be taxed, and it's going to be taxed now. So what therefore would be that gain? You've got the information here in front of you on this working. You have received cash, i.e. sale proceeds, of £30,000, against which you have now established the allowable cost, £8,000. Therefore, proceeds 30 less cost 8, there is a gain of £22,000. All we've done is again split what was the original shares share cost, here £40,000, between the mixed bag of goodies received at the point of takeover, based on that mixed bag of goodies market values. The amount of cost attributed to the cash is 8,000. The cash received, your sales proceeds, is 30. So your gain, immediate gain taxable, is 22,000. As before, any gains in relation to the shares received, share for share relief applies, unless, as we've learned in this particular lecture, you choose to elect to disapply that deferral. But if you don't, then your £120,000 worth of shares in FC are deemed to have cost 32,000. So when those shares are sold in the future, those 30,000 shares would be deemed to have that cost of 32, and you can put that allowable cost against any resultant sale proceeds. If, of course, the amount of shares that we got took us from now qualifying for entrepreneurs relief to not in the future qualifying for entrepreneurs relief, then as we said earlier in this session, that's the situation where you want to elect to disapply the share for share relief. What would happen? Exactly the same as you've just seen with the cash. You'd have proceeds 120, cost 32. That immediate gain, what would that be? £88,000 would then become immediately chargeable. But that's only going to happen if you choose to elect to disapply the share for share relief. If no such election is made, then the new shares acquire 32,000 out of the total £40,000 cost of the old shares. And when those new shares are sold in the future, there's your base cost to use. The only time we're going to make this election, or at least ask our client to consider making that election, is where we would be exchanging a gain taxable now at 10% for a gain taxable in the future at 20%. We like the idea of paying tax later, but we don't like the idea of doubling that tax charge. Better, therefore, overall, to pay tax sooner at 10% than later at 20%. Okay, so where cash is received at that point of takeover, there is immediate gain to crystallise. And as the note said, you've got there example 5, which again, like I've just gone on and changed there my classwork example from last time. Example 5 simply changes a bit of information in there as regards what was in example 4. And what now happens, of course, there's an element of cash being received at the point of takeover. Follow the techniques that we've just identified there, work that through, and check out your answer then in the back. In our next session together, as we've just suggested, we move to look at, and it's a very long chapter, at the most important area of CGT reliefs that are available to individuals. The first of those will be entrepreneurs relief. The type of relief that it is the ability to use a lower tax rate. A tax rate of 10% instead of what would otherwise have been 20%. halving therefore your tax charge. That is indeed a relief. Most other reliefs that exist in reality and are going to be within your particular syllabus anyway are deferrals. What they do is to recognise a situation where a chargeable disposal of a chargeable asset has occurred and you're a chargeable person. Therefore, a gain must be computed. A gain that may be computed in the case of a gift based on market value, for example. But although we've computed the gain at this point in time, there may be a relief that is available. The one that we mentioned in our first discussion at the beginning of, or early on in chapter 12 anyway, was to do with a gift. And we suggested, again, creative creatures as we are, that we have a relief to deal with a gift. Ooh, what should we call it? Huge surprise, we call it gift relief there. And what that does, that you'll see in the next chapter, simply introducing it to the concept to you now, is that we'll get a deferral of the gain. The gain will be deferred now to a later point in time. That will be seen to be the point at which the recipient of the gift in the future disposes of that asset and receives cash. Whenever you receive cash, that's when the gain is going to crystallise. There's another relief, it's called rollover relief. It's another deferral relief that applies. That too we'll see in our next session. And then there's one other relief, and this is the third and final type of relief. Entrepreneur's relief was a lower tax rate, 10% tax rate rather than 20% in most circumstances. Main area of reliefs in CGT, and this is 2 of the 4 reliefs that you need to know over and above our discussion a moment ago of share for share relief. We've got gift relief, we've got rollover relief. They are deferrals. So we're still computing the gain now, but instead of taxing it now, it'll be taxed in some way in the future. The events that give rise to that we see in not the next lecture, but the next chapter. There's going to be a number of lectures on that next chapter as I take you through those reliefs. The last type, the third category and the fourth relief we'll need to know about, is actually a relief that exempts some or all of a gain from arising. Now that's as good as it gets, to exempt some or all of a gain. If you've got a choice between deferring a gain or exempting a gain, you know what you're going to do. You're going to exempt, it's gone for good, rather than deferring, which is, we don't have it now, but we're going to meet that gain at some point in the future. And that relief is called Principal Private Residence Relief. Principal Private Residence Relief. That most taxpayers in the UK, certainly ones that we're going to meet in exam questions, will have their own home that they live in. And in which case, therefore, it's known as your principal private residence. The precise definition of this, again, in the next chapter. And what is very good news here is if you buy your house, you live in your house, and at some point, years in the future, you sell, and you sell for significantly more than you had originally paid for that, then in the vast majority of circumstances, all of that gain will be covered by this principal private residence relief here. All of it, 100% of the gain will be exempted through PPR relief. Now, in an exam question, of course, it's not going to be much of a question if it's just the whole gain is eligible for 100% relief and therefore there'll be nothing taxable. So what we'll discover when we look at principal private residence relief is there are certain things that may happen during the period of ownership of that principal private residence of the taxpayer that may mean that PPR, principal private residence, PPR relief, is not available in full, and therefore some part of that gain becomes chargeable. So chapter 14, an important one, a big one, covers entrepreneurs relief, a lower tax rate, 10%, rollover relief and gift relief, deferrals of immediate gains to a later point in time, and principal private residence relief that actually exempts some, if not all, of a gain arising when a taxpayer disposes of his or her PPR, their principal private residence. Okay, think upon the things that I've just said. Go back over what I've said again before we get to the next chapter. This is as a backdrop to that to help explain the issues that we contend with within Chapter 14.